So imagine engineering this completely revolutionary piece of medical technology, announcing it to the entire healthcare industry, generating massive buzz, and then just intentionally watching your current sales stall out.
Yeah, it sounds completely backward.
Right. You literally introduce a product so good that your customers stop buying from you today just so they can wait to buy from you tomorrow.
Exactly.
And believe it or not, according to management, this was a brilliant, highly calculated strategic move.
It's basically the ultimate test of corporate patience. I mean, you're essentially telling Wall Street, hey, we are going to freeze our own near-term revenue because the long-term payoff is just this absolute monopoly on hospital infrastructure.
Which takes nerves of steel.
Nerves of steel. And honestly, it takes a very understanding investor base to execute that while publicly traded.
Totally. Well, welcome to this Talk Tickers edition of The Deep Dive. Our mission today is to really cut through the corporate speak and take this massive stack of information from the Q1 2026 earnings call for Omnicell.
That's ticker symbol OMCL for those tracking.
Right, OMCL. And we're going to break it down specifically for you, the retail investor. We're going to analyze the financial health of this healthcare tech provider, translate the Wall Street jargon, and figure out exactly what these numbers mean for your portfolio.
Because if you just look at the surface level narrative of this quarter, it is full of contradictions.
It really is. Reading these earnings transcripts, it's kind of like checking the vital signs of a patient, right? You're looking for strong pulses in revenue, healthy margins, but you're also listening for any irregularities in management's tone.
Which is exactly why we can't just skim the press release here. We really have to look at the underlying mechanics of how Omnicell actually makes its money.
Right.
To even begin to understand this quarter's earnings, you have to understand the specific logistical nightmare that Omnicell is trying to solve inside modern hospitals.
So let's actually set the stage mechanically before we even get to the revenue beats and margin expansions.
Yeah.
Because I think most people, when they picture a hospital, they visualize doctors performing surgery or nurses checking IVs.
Yeah, the clinical side.
Exactly. But there is this massive hidden supply chain happening basically behind the drywall. Like if I'm a patient in a hospital bed and the doctor prescribes me a painkiller, what actually has to happen for that pill to reach my mouth?
Well, historically, it's a terrifyingly manual process.
Right.
The historical baseline is just fraught with human error. I mean, usually that prescription order goes down to a central pharmacy, which is often just located in the basement of the hospital.
Just a windowless room somewhere.
Pretty much. And a pharmacy technician receives a printout. They literally walk through aisles of bulk medications, physically count out the required number of pills, put them in a little plastic baggie, label it, and then somehow transport it up to the patient floor.
Wait, like in a tube?
Maybe a pneumatic tube system, yeah. Or maybe they just physically push a cart onto the freight elevator.
Wow. And once it actually gets to the floor, does it just sit at a nurse's station?
In the old days, yes. Or, in a locked drawer. But obviously that introduces massive security and safety risks, especially with controlled substances.
Oh, absolutely.
So over the last couple of decades, hospitals started installing automated dispensing cabinets right on the patient floors. And this is really where Omnicell made its name.
Right, building the hardware.
Exactly. They build these massive, highly secure, computerized metal cabinets. So the pharmacy tech brings the medication up and loads it into the cabinet. Then later, when the nurse actually needs the medication, they log into the cabinet using like a biometric scan or an ID badge.
So the cabinet actually knows who's accessing it.
Yes, and it verifies the patient's electronic health record and then pops open only the specific drawer or little bin containing the exact medication needed.
Okay, so it functions like a highly advanced, incredibly secure vending machine for life-saving drugs.
That's a great way to look at it.
The nurse literally can't accidentally grab the wrong dosage because the machine physically restricts access to anything else.
Exactly, but that's just the hardware piece. Their legacy product line was called the XT cabinets. But Omnicell, they don't just build the metal boxes, they also build the digital infrastructure.
Right, the software side.
Yeah, a cloud-based platform called Omnisphere. So Omnisphere acts as the central brain. It connects all of these dispensing cabinets across the entire hospital network, tracks the inventory in real time, and alerts the central pharmacy when, say, a cabinet on the 4th floor is running low on Tylenol.
It's orchestrating the whole workflow.
Exactly.
And that brings us to their new flagship system, right? The Titan XT, which was at the very center of this Q1 earnings call. They kept talking about building what they call the autonomous pharmacy.
Yeah, the autonomous pharmacy. That implies they want to remove the human element even further.
They want to eradicate the manual counting and the sorting completely.
Right. I mean, a pharmacist went to school for years to understand complex drug interactions and patient care. They shouldn't be spending 4 hours a day manually counting pills into baggies.
No, it's a huge waste of resources.
So Omnicell wants robotics in the central pharmacy to do all the physical counting and packaging and software to handle the tracking so humans can just focus entirely on the patient.
So keeping that whole overarching mission in mind completely recontextualizes the vital signs of this operation. Let's actually look at the headline numbers for the first quarter of 2026.
Do it.
I'm going to fire off the critical data points here because from a top-down perspective, these results look incredibly robust. Total revenue hit $310 million.
Wow.
Yeah, that represents a 15% year-over-year growth rate compared to Q1 of 2025.
Which is a top-line beat that clearly caught some analysts off guard, especially given this massive transition period the company is currently navigating.
Totally. And breaking that $310 million down into its components gives us an even better picture. Product revenue, which is the physical hardware the cabinet's being installed, was $175 million. That is up 20% year over year.
That's a huge jump for physical hardware.
It is. Then you have the service revenue, which covers their software subscriptions like Omnisphere, ongoing maintenance contracts, all that stuff. That segment came in at $135 million.
So an 8% increase there.
Yep.
You love to see both cylinders firing like that. I mean, in enterprise tech, you often see this dynamic where hardware sales just plummet while a company transitions to a software as a service model.
Or the exact opposite, right?
Yeah, or hardware spikes, but they can't seem to attach the recurring software revenue. But Omnicell is demonstrating that they can successfully pull both levers simultaneously.
But, okay, the metric that really demands attention here is their profitability. Non-GAAP earnings per share, their EPS, more than doubled year over year.
Doubled?
Yeah, they posted $1.55 per share, up from just $0.26 in the exact same quarter last year. And their non-GAAP EBITDA reached $45 million.
That's significant.
And management, specifically CEO Randall Lipps and CFO Barrett Redford, they were super quick to point out on the call that these results were at the high end or above their previously issued guidance.
Yeah, the tone of the call was remarkably confident. They really framed this entire quarter as a masterclass in solid execution and disciplined cost management, especially in the face of macroeconomic headwinds.
But, you know, I have to play the skeptic here for a second.
Go for it.
Because as retail investors, we listen to these earnings calls and we constantly hear management teams patting themselves on the back. Like, we beat our guidance, we executed flawlessly. But let's be real, companies manipulate their own guidance all the time.
It's true, the classic sandbag.
Exactly. They intentionally set the bar incredibly low in Q4 so that they can just effortlessly step over it in Q1 and claim a massive victory. So my question for you is, are these numbers actually a reflection of stellar operational performance, or did Omnicell just sandbag their estimates?
You're hitting on the core tension of evaluating literally any earnings beat. It's just standard operating procedure for a CFO to underpromise and overdeliver. But if we peel back the layers and look at the underlying operational metrics, this specific quarter actually doesn't look like a financial mirage. The ultimate lie detector in this scenario is their gross margin.
Okay, let's focus intensely on that because gross margin is really where the rubber meets the road for operational efficiency.
Yeah.
What did that margin profile actually look like?
So in the first quarter of 2026, Omnicell's non-GAAP gross margin expanded to approximately 46%.
Okay.
And to truly understand the magnitude of that figure, you have to look at the historical context. In the first quarter of 2025, their gross margin was sitting at 42%. And for the entirety of the 2025 fiscal year, it hovered around an average of 44%.
Wow. Okay, so we were talking about a 400 basis point expansion year over year, a full 4% leap in gross margin.
Exactly.
And in the world of healthcare hardware, where you're dealing with physical steel, silicon, actual complex supply chains, a 400 basis point jump is not something you can just conjure up with clever accounting tricks.
No, it's a massive structural shift. To translate this out of Wall Street jargon for a second, Omnicell is not merely selling a higher volume of metal cabinets and software licenses. They are fundamentally keeping significantly more profit from every single dollar they generate compared to 12 months ago.
Which is exactly what you want to see.
Right. It's a textbook demonstration of operating leverage. As their revenue scales up, their cost of goods sold is not scaling at the same aggressive rate. They are just becoming ruthlessly efficient at delivering their product to the hospital floor.
Which naturally leads to the most important question an investor can ask, right? High margins are obviously the goal, but you can't just look at the final score on the board.
No.
You have to understand the specific plays the team ran to win the game. So how exactly did management engineer a 46% gross margin in this specific quarter? Because understanding the how tells us if this is a repeatable trend or just a one-off fluke.
Right. And the CFO, Barrett Redford, provided a very detailed roadmap of how they achieved this. He pointed to two primary drivers.
Okay, what was the first one?
First, on the product side, they experienced incredibly strong demand and a highly favorable customer mix in their connected devices portfolio. And crucially, this wasn't just geographically isolated. They highlighted robust sales across both North American hospital networks and their international markets.
Now, when they say favorable customer mix, they usually mean they sold a higher proportion of their premium, high-margin products compared to their entry-level stuff, right?
Exactly.
Like the hospitals weren't just buying the basic empty cabinets, they were outfitting them with the advanced features that carry a much heavier price tag but cost roughly the same to manufacture.
That is the exact mechanism of a favorable mix.
Yeah.
You get more revenue for roughly the same physical cost. But the second driver Redford discussed is arguably even more important for understanding this specific margin leap.
Okay.
And it relates directly to the service side of their business. He explicitly stated that they are now, and I'm quoting here, lapping last year's costs.
Okay, I really want to spend some time on this concept of lapping costs because I think it's one of the most misunderstood accounting dynamics for retail investors. What specific financial burden was Omnicell carrying last year that they've suddenly just shed?
To understand this, we have to rewind to 2025. Throughout last year, Omnicell was forced to undertake this massive, incredibly expensive initiative involving field-based software upgrades at their existing customer sites.
What does a field-based software upgrade actually entail in the physical world?
It means they couldn't just push an over-the-air update from their headquarters like Apple does with an iPhone.
Oh, because of hospital security?
Exactly. Because of the strict security protocols, legacy hardware constraints, and just the sheer complexity of hospital IT networks, Omnicell had to physically deploy technicians.
Oh, wow.
Yeah, they were literally putting highly paid service personnel into vans, driving them to hospitals across the country, walking onto the clinical floors, and manually upgrading the software on the installed base of XT cabinets.
The logistics of that sound like an absolute nightmare. You're paying for travel, lodging, overtime, and you're actively disrupting the hospital's workflow while the technician has the machine cracked open.
It was a massive headwind to their profitability. I mean, every hour a technician spends doing a manual upgrade is an hour they're not doing billable maintenance or installing new revenue-generating equipment. That effort acted as a heavy anchor, just dragging down their service gross margins for the entirety of Q1 2025 and throughout the whole year. But today,
Let me guess, they finished it.
that upgrade cycle is complete. Those costs are now entirely in the rearview mirror.
You know, this mechanism reminds me so much of going through a major home renovation.
Oh, that's a good comparison.
Last year, you were in the thick of it. You were writing these agonizingly large checks every single Friday to the general contractor, paying for plumbers to rip out pipes, electricians to rewire the kitchen. Your bank account is just taking a relentless beating, right?
You're painful.
It's super painful. Cash flow is terrible. But then January rolls around, the contractors finally pack up their trucks and leave, the tools are gone. Now, you just get to sit in your living room and enjoy the increased equity of your home and the beautiful new kitchen without that massive draining expense hitting your checking account every week.
That analogy captures the financial reality perfectly. The heavy lifting, the capital-intensive phase of that specific software upgrade cycle is finished.
So the margins can finally breathe.
Exactly. Now, the Q1 2026 financial statements are finally allowed to reflect the true, unburdened profitability of their recurring service revenue. The anchor has been cut, and the margins naturally floated upward.
But, and this is where the detective work gets really fascinating, if you only read the press release, you walk away thinking 46% is the new normal.
Right?
But if you actually listen to the Q&A portion of the earnings call, you catch a very crucial piece of nuance. An analyst named Gene Menheimer from Baird really pushed the CFO on this exact topic. He wanted to know about the sustainability of this profitability.
Good question.
Yeah, and Redford made a very revealing admission about how they managed their expenses this quarter.
Yeah, Redford's response is the absolute key to accurately modeling this company for the rest of the year. He essentially admitted that part of the reason the Q1 profitability looked so spectacularly high was due to timing. They actively shifted some planned operational expenses out of the first quarter and pushed them into the second and third quarters of 2026.
So they didn't permanently eliminate those costs. They literally just rescheduled them.
Yeah.
What kind of expenses are we talking about here?
Well, he didn't give an itemized receipt, obviously. But in this industry, shifted OpEx usually means delaying discretionary spending. It could be delaying the hiring of new sales reps, maybe pushing back a major marketing campaign for the Titan XT launch, or deferring internal IT projects.
Right.
They basically found the flexibility to keep their core operations running smoothly without actually cutting the checks in Q1. But, those bills still have to be paid eventually.
Right. The piper must be paid. And because of that shifting, management was very careful to manage expectations. They cautioned the analysts that while a 46% gross margin is phenomenal, it really represents the absolute upper end of their margin potential in the near term.
Yeah, they are explicitly telling investors, do not build your spreadsheets assuming 46% is the new floor. It's a ceiling.
That's a great distinction.
They fully expect their margins to fluctuate from quarter to quarter depending on the mix of products sold and the specific timing of when these delayed investments actually hit the ledger.
So the Q1 earnings beat is completely legitimate. They didn't invent the money. But investors need to be psychologically prepared for the reality that the expenses Omnicell artfully dodged in January and February are going to come home to roost in June and August.
Exactly.
The margins might compress slightly in Q2 and Q3 as they catch up on that spending.
Right. It requires a much more sophisticated view of the financial calendar. But, looking backward at Q1 or even looking at the shifted expenses for Q2 only gives us a fraction of the narrative. If you're going to commit your capital to this stock, you can't just drive by looking in the rearview mirror.
You have to look at the roadmap.
We have to analyze their forward-looking guidance.
And the updated guidance they provided for the full year of 2026 was arguably the most revealing part of the entire call, mostly because of the stark contrast between what they changed and what they aggressively refused to change.
It was very telling.
So let's lay the numbers out clearly for you listening. For the full year of 2026, total revenue guidance is maintained at a range of $1.215 billion to $1.255 billion. Product bookings, which is a critical metric representing the total dollar value of the firm contracts they expect to sign this year, are also maintained at a range of $510 million to $560 million. Top-line expectations are absolutely flat.
Right. However, the bottom line metrics paint a totally different picture. Non-GAAP EPS guidance for the full year was raised to a range of $1.08 to $2. That is a meaningful bump up from their previous estimate of $1.65 to $1.85.
Wow.
And their non-GAAP EBITDA guidance was also raised to a new range of $153 million to $168 million.
So flat revenue, but significantly higher profits. Now, I have to step in here and play the role of the confused retail investor because there is a glaring logical disconnect in this narrative.
Okay, let's hear it.
Management spent an enormous portion of this earnings call practically doing backflips over their new flagship product, the Titan XT. They officially introduced the concept late last year. They're talking about how beta customers are absolutely obsessed with the new dynamic restock capabilities, how the guided workflows are revolutionary.
They're hyping it up.
Right. They say there is unprecedented buzz building in their sales pipeline. If this new product is truly the massive paradigm-shifting game changer they claim it is, why on earth aren't they raising their revenue or bookings guidance for the year? Why is the top line totally stagnant in the face of supposedly massive demand?
I get it. It feels incredibly counterintuitive. I mean, in the consumer electronics world, if Apple announces a groundbreaking new iPhone, they immediately revise their revenue projections upward because millions of people are going to swipe their credit cards the following Friday.
Exactly.
But we have to completely discard that consumer mindset here. To understand why Omnicell's top line is flat despite having this hot new product, we have to deeply analyze the brutal mechanics of enterprise healthcare sales. We are talking about multi-quarter, sometimes multi-year sales cycles.
Break down that cycle for us. Why does it take a hospital 2 years to buy a cabinet?
Well, a hospital is just a labyrinth of bureaucracy, risk aversion, and really tight capital constraints. They don't just see a slick marketing brochure for the Titan XT and issue a purchase order.
Right.
When Omnicell walks into a hospital system and pitches the Titan XT coupled with the new Omnisphere cloud platform, they aren't just selling a machine. They're asking the hospital to fundamentally redesign how they manage narcotics and critical medications across their entire enterprise.
So it isn't just the director of pharmacy making this decision on a Tuesday.
Not even close. You first have to convince the pharmacy director that the clinical workflow is actually better. Then, because the cabinets are connected to the cloud, the hospital's IT security committee has to spend months auditing Omnicell's software to ensure it complies with IT and can't be breached by ransomware.
Oh, the compliance aspect alone.
It's massive! Then, the nursing union, or nursing leadership, has to agree to change their physical daily routines to accommodate the new system. And finally, after all of that, you have to go to the CFO and the hospital's capital allocation committee and fight for millions of dollars in a budget that was likely locked down 18 months ago.
That is a staggering gauntlet to run just to secure a single contract.
It takes time.
And this brings us back to the Osborne effect analogy I mentioned at the very beginning of the show. During the Q&A, an analyst named Randall Lipps brought up this exact friction point. He asked a brilliant, really pointed question. Is the mere announcement of the futuristic Titan XT actually causing hospitals to cancel or delay their planned purchases of Omnicell's older existing equipment?
And Randall Lipps, the CEO, did not try to spin it.
Yeah.
He gave a very candid, direct answer.
He admitted it.
He did. He acknowledged that, yes, the introduction of Titan XT has fundamentally altered the purchasing dynamics in the market. Just imagine a hospital CFO who was just about to sign a $5 million contract to replace their aging cabinets with Omnicell's current XT line.
Right.
Suddenly, Omnicell announces that the revolutionary Titan XT hardware is coming in the second half of 2026, and the accompanying next-generation software is rolling out in 2027.
If I am that hospital CFO, I am immediately slamming the brakes. I'm putting the pen down. I am absolutely not going to spend $5 million today on technology that Omnicell themselves just declared is about to become the previous generation.
Yeah. Precisely their reaction. The hospital administrators are saying, let's pause. If we buy the old system today, our clinical staff is going to be furious in 12 months when they see the new features of the Titan XT. And furthermore, we only get approval to upgrade these pharmacy systems once every 10 years. How do we rewrite our strategy to feather this new Titan technology into our long-term capital plan?
So the sheer existence of a superior future product is literally freezing the current pipeline.
Yes.
But what is truly fascinating here is the mechanics of why the Titan XT is so highly desired that hospitals are actually willing to delay their upgrades just to get it.
Yeah.
You mentioned dynamic restock earlier. Mechanics really matter here. If I'm a pharmacy tech, how does dynamic restock actually change my physical reality on the hospital floor compared to the old system?
Okay, so in the current legacy system, restocking a cabinet is a highly rigid, frustrating process. The machine has specific drawers configured for specific pill sizes. If a drawer is designated for 500 milligram aspirin, and the pharmacy suddenly needs to stock a massive influx of different antibiotic because of, say, a localized outbreak, the tech has to manually reprogram the drawer, physically swap out the plastic dividers, and essentially rebuild the cabinet's internal map. It takes hours of manual labor.
That sounds incredibly inflexible.
It is, but dynamic restock on the Titan XT fundamentally changes this through advanced sensors and software. The cabinet automatically recognizes the physical dimensions and weight of the new medication bin being inserted.
Oh, wow.
Yeah, it dynamically reallocates its internal tracking without the pharmacy tech having to manually reprogram anything. The software instantly updates the inventory map. It turns a 2-hour manual reconfiguration into a 5-second plug-and-play operation.
That's a huge time saver. And what about the guided workflows they mentioned? How does that actually impact the nurses?
So guided workflows use localized lighting and software prompts on the cabinet's interface to physically guide the nurse's hand to the correct medication.
Like actual lights on the machine.
Exactly. In a high-stress trauma situation, when a nurse logs in, a bright LED path instantly illuminates, pointing directly to the exact drawer and the exact bin containing the required drug. It dramatically reduces the cognitive load on the nurse and practically eliminates the risk of pulling the wrong medication in a panic.
Okay, when you explain the mechanics like that, it becomes incredibly obvious why a hospital would refuse to buy the old system and choose to wait for the Titan XT. They're basically buying a decade of operational efficiency.
Exactly.
But returning to the financial impact, Lipps noted that this delay is actually a positive for Omnicell in the long run. By waiting for the newer, more advanced system, hospitals are actually upsizing their potential deal values.
Yep.
The Titan XT commands a premium price, so the total value of the pipeline is swelling, but the actual signing of the contracts, and crucially, the recognition of that revenue on the income statement, is being pushed further out into the future.
This is why management claims this temporary freeze was entirely intentional. They deliberately launched the Titan XT concept in late 2025, precisely to give these massive healthcare bureaucracies the runway needed to start their multi-quarter budgeting process.
Because they know how slow the system is.
Right. They knew that if they want hospitals to buy Titan XT in 2027, they have to get the product into the hospital's capital planning meetings today.
It's a game of 3D chess, and the timing here is not accidental. The first generation of their older XT cabinets originally shipped back in 2017. So as we sit here in 2026, those original machines are hitting their 10th year of continuous 204/7 operation.
Which is old for that kind of hardware.
Very old. They are nearing the end of their mechanical lifespan. Omnicell knows a massive industry-wide replacement cycle is looming. They estimate the total addressable market for replacing these aging units is in excess of $2.5 billion. They just have to be incredibly patient while the wheels of hospital administration slowly turn.
Which perfectly summarizes why the guidance looks the way it does. The raised EPS and EBITDA reflect their current operational discipline. They are extracting maximum profitability out of the older systems they're still shipping and the service contracts they are maintaining.
Right.
But the flat revenue and bookings guidance is just a realistic acknowledgement of the harsh reality of a slow-moving healthcare system caught in the middle of a major product generation transition.
Right. Before we move off the topic of revenue, I want to touch on a structural change to their sales cadence that management highlighted. They kept using the phrase revenue linearity.
Yes, that was interesting.
Because I've followed enterprise software companies for years, and they are notorious for what Wall Street calls the hockey stick quarter.
The end of quarter scramble.
Exactly. For the first 2 months of the quarter, the sales team closes almost nothing. The revenue chart is totally flat. And then in the final 2 weeks of the quarter, sheer panic sets in. The executives start screaming at the sales directors. The reps start offering massive margin-destroying discounts just to get signatures. And 80% of the quarter's revenue spikes upward in a chaotic scramble at the finish line.
It's toxic.
It creates this wildly unpredictable, lumpy revenue profile. Is Omnicell suffering from that same end-of-quarter crunch? Or is this linearity concept something different?
You've perfectly described the exact dysfunction that Omnicell is actively trying to cure. Historically, healthcare tech suffered from that exact same hockey stick dynamic. It is a terrible way to run a supply chain.
Totally.
If 80% of your orders come in on the last day of the quarter, your manufacturing facilities and your installation technicians are completely overwhelmed, leading to massive inefficiencies and overtime costs.
It's basically institutionalized chaos.
Exactly. But management noted that they have made a concerted structural effort to smooth this out. Going into 2026, they worked diligently to build a much healthier backlog of orders.
Okay.
More importantly, they changed how they coordinate with their customers regarding the actual delivery and installation dates of the equipment.
Yeah.
They are no longer incentivizing the sales team to cram deals into the final week just to hit a quota.
So they are prioritizing operational stability over the adrenaline rush of a massive quarter-end beat.
Yes, and because of this operational discipline, they are seeing their revenue flow much more linearly. The sales and installations are spread evenly across all 3 months of the quarter. The chart looks like a steady upward slope rather than a flat line followed by a massive spike.
That seems unequivocally positive. Less chaos means better resource planning, which probably contributes significantly to that 46% gross margin we discussed earlier. You aren't paying technicians triple overtime to install a machine at 11 p.m. on the last day of March.
It is a much healthier, more mature way to run a multi-billion-dollar enterprise. However, for a retail investor used to high-flying tech stocks, it does change the narrative slightly.
How so?
Well, because the revenue is smoothed out, you are way less likely to see those massive, shocking blowout quarters where revenue beats estimates by 30% due to a last-minute flurry of mega deals. The revenue profile going forward will be more muted, more predictable, and frankly, a bit more boring.
But boring is often highly profitable.
Boring is beautiful when it comes to cash flow.
Right. So let's pivot to the competitive landscape because there was a massive revelation during the call that we absolutely have to unpack. An analyst named Sean Hawks asked about Omnicell's market position, and in the response, management casually dropped the fact that their primary competitor is currently dealing with a Class 2 FDA recall on their equipment.
This is an incredibly critical dynamic that is giving Omnicell a massive tailwind right now. While Omnicell is touring the country, showcasing the futuristic Titan XT, their biggest rival in the automated dispensing space is bogged down dealing with federal regulators and a recall on their existing hardware.
Wow. And for context, a Class 2 FDA recall means the product might cause a temporary or medically reversible adverse health consequence.
Yeah.
It isn't necessarily immediately life-threatening, but it is a massive red flag for a hospital's compliance department.
A huge red flag.
If I am the IT director or the director of pharmacy at a hospital currently using that competitor's equipment, I am not just annoyed, I am actively looking for the fire exits. I cannot afford to have the FDA breathing down my neck because my vendor's technology is failing compliance standards.
Your analogy is spot on. The hospital administrators are looking for a way out. Nnamdi Njoku, Omnicell's chief operating officer, noted that this recall has prompted major health systems to actively reassess their incumbent solutions.
Which makes perfect sense.
Hospital procurement operates on risk mitigation. When a hospital sees their current provider struggling with basic reliability and regulatory compliance, and simultaneously, Omnicell's sales team is knocking on the door offering a brand new, highly advanced platform, it creates the perfect storm for a competitive conversion.
And a competitive conversion in this space is massive. You aren't just winning a new customer. You are physically ripping your competitor's hardware out of the hospital walls and installing your own.
It's the ultimate market share capture. Now, management was somewhat conservative in their public projections. They only assumed a modest increase in competitive wins within their 2026 guidance.
Probably to be safe.
Right. But reading between the lines, it is abundantly clear that the leadership team feels they have been handed a golden opportunity. They are in an incredibly strong strategic position to capitalize on their rivals' missteps. Njoku even mentioned that the demand from hospitals wanting to physically see the new technology is so overwhelming that Omnicell had to double and in some regions triple the amount of demonstration equipment they have deployed in the field.
That is the definition of pipeline buzz right there.
Absolutely.
But, we've focused almost entirely on the massive hospital networks so far. Omnicell has another segment of their business that isn't quite as glamorous, but is just as important. I'm talking about their EnlivenHealth segment, which serves the retail pharmacy space. Analyst Stan Bernstein asked about this during the Q&A, and the tone seemed noticeably more subdued.
Subdued is definitely the right word. While the hospital side of the business is gearing up for a massive replacement cycle, the retail pharmacy footprint is navigating an entirely different set of macroeconomic realities. EnlivenHealth provides patient engagement software, automated refill reminders, and omni-channel communication tools for neighborhood retail pharmacies.
Right. And as anyone who has paid attention to the news or even just tried to pick up a prescription at their local CVS or Walgreens recently knows, the retail pharmacy sector is in the middle of an absolute crisis.
It really is.
We are seeing massive staffing shortages, pharmacists walking out due to burnout, thousands of physical store closures across the country, and severe margin compression caused by pharmacy benefit managers. It's a brutal environment. So how is Omnicell software supposed to thrive when their customers are literally boarding up their windows?
It is an incredibly challenging headwind. Njoku, the COO, had literally just returned from a major retail pharmacy industry conference right before the earnings call, and he was very frank about the pain the industry is feeling.
I bet.
However, he also noted a subtle but important shift in the conversation among pharmacy executives. For the past 2 years, retail pharmacies have been in pure survival mode. But now they're slowly starting to look forward again.
Looking forward to what? Survival still seems like the primary goal.
Looking forward to solving the fundamental math problem they face. Physical stores are closing, but the actual volume of prescriptions being written by doctors is still growing every year.
Well, yeah, people are getting older.
Exactly, they need more medication. So the remaining pharmacies are being forced to handle a massive influx of prescription volume, but they simply cannot find or afford the human pharmacists to process the work. The conversation at the executive level has shifted from how do we survive to how do we process 20% more prescriptions with 10% fewer staff.
Wow. And the only mathematical answer to that equation is technology?
Exactly. You have to automate the busy work. If EnlivenHealth software can automatically text a patient, coordinate their refill, verify their insurance, and schedule their pickup without a human pharmacist ever having to pick up a telephone, that software goes from being a luxury add-on to an absolute operational necessity.
That makes total sense.
So while the retail pharmacy macro environment remains deeply troubled, Omnicell is fiercely positioning EnlivenHealth as the exact tool these chains need to do more with fewer resources.
Okay, We have covered an immense amount of ground here. We've dissected the 400 basis point margin expansion, the reality of lapping last year's hardware upgrade costs. We've mapped out the grueling gauntlet of hospital procurement, the Osborne effect freezing the current sales pipeline, the revolutionary mechanics of the Titan XT, the competitor's FDA recall, and the stabilizing desperation of the retail pharmacy sector.
We really went through it.
We've synthesized a mountain of complex data. So now it's time for the final verdict. What is the bottom line here? If I am a retail investor listening to this deep dive, what is the actionable takeaway for my portfolio?
If we look at the totality of the data, the underlying narrative here is a strongly bullish signal for Omnicell's long-term execution. However, it comes with a massive, unavoidable caveat. This stock currently requires an incredibly patient investor.
Patient specifically because of those multi-year enterprise sales cycles we spent so much time discussing.
Precisely. This is a company attempting to execute a high-wire act in the middle of a massive product generation transition. They are actively trying to take market share from a wounded competitor. They are introducing a foundational new technology platform that fundamentally changes hospital operations. And somewhat miraculously, they are managing to significantly expand their profitability while doing it.
That's impressive.
That level of operational discipline is rare, but the massive revenue windfall that everyone is anticipating from the Titan XT is absolutely not going to materialize on the income statement next month or even next quarter.
So let's put the audience into two camps and make this highly actionable. If a listener is currently holding OMCL stock in their portfolio right now, what should they do?
If you are already holding the stock, the raised profit guidance for the full year is your anchor. It proves the business model is resilient. Furthermore, you have to look at their cash generation.
Oh, right, the free cash flow.
Omnicell generated $39 million in free cash flow in the first quarter alone. To put that in perspective, they only generated $10 million in the exact same period last year. That is almost a 400% increase in cash generation.
That is a phenomenal sign of underlying health. What are they actually doing with that cash?
They're using it to fortify their foundation. Over the last year, they repaid $175 million in outstanding debt, and they initiated a $78 million stock buyback program. Their balance sheet is rock solid. They have the financial strength and the cash reserves to comfortably weather this multi-quarter transition period while hospital CFOs slowly approve the new budgets. For a current shareholder, unless your investment thesis has fundamentally changed, there is a very compelling reason to stay put, collect the buyback value, and wait for this massive $2.5 billion replacement cycle to kick into high gear.
Okay, and what about the second camp? What if a listener doesn't own the stock, but they just heard us explain the vision of the autonomous pharmacy and the Titan XT, and they want in? What is the play for someone considering initiating a new position?
If you're watching from the sidelines and considering buying, you must understand that management has explicitly telegraphed that this is a back half weighted story for 2026, and realistically, a 2027 revenue story. The initial Titan XT hardware units won't even begin shipping to hospitals until the second half this year.
So it's still a ways out.
And the full Omnisphere software rollout, which ties it all together, is slated for the first half of 2027.
So buying today really means buying the anticipation, not the actual revenue.
Exactly. The real catalyst that will move the stock price in the near term won't be top-line revenue, it will be the bookings metric. Investors need to see proof that the current pipeline buzz and the competitor's recall are actually translating into legally binding signed contracts.
Watch the bookings.
Keep a hawk-like watch on the Q3 and Q4 product bookings numbers. That is the exact moment we will see if the massive hype surrounding the Titan XT officially becomes future revenue.
That is incredibly clear and actionable. Strong operational execution today, but a timeline that demands significant patience for the top-line explosion.
Well said.
As we wrap up this deep dive into the source material, I want to step back from the quarterly spreadsheets and the margin calculations for a minute. I want to leave you with a broader, almost philosophical trend to ponder, something that stretches far beyond just Omnicell's specific financial footprint.
And that is the ultimate endgame of this entire industry, the fully autonomous pharmacy.
Exactly. Omnicell is betting hundreds of millions of dollars in R&D and essentially their entire corporate future on the core premise that manual medication management will soon be viewed as an archaic, dangerous relic of the past.
Right.
And when you look at the macro picture of the global healthcare system, it is very difficult to argue against that thesis. Hospitals across the world are facing systemic, chronic, and seemingly unsolvable staffing shortages.
It's a crisis everywhere.
Nurses are burning out at unprecedented rates, and clinical pharmacists are stretched dangerously thin. We heard management explicitly state that one of the primary selling points for the new Titan XT isn't just inventory control. It is fundamentally about reducing the amount of time a highly trained nurse spends wandering in a hallway looking for a missing baggie of pills.
It is about buying back time, giving them time back at the bedside where their human empathy and clinical judgment actually matter.
Right. A robot cannot hold a patient's hand or notice a subtle change in their breathing. But a robot is infinitely better at counting 50 milligrams of a narcotic without making a math error.
Absolutely.
So the provocative question I want to leave you with is this: how long until the manual counting, sorting, labeling, and physical distribution of medications is entirely eradicated from the hospital environment? If advanced AI algorithms, cloud-based tracking software, and high-precision robotics can eventually handle the entire medication lifecycle with absolute zero human error, the implications for patient safety, preventing deadly adverse drug events, and hospital economics are absolutely staggering.
It's huge.
And if the pharmacy basement is right for this exact type of automated revolution, you have to ask yourself, what other hidden logistical corners of the healthcare sector are currently relying on exhausted manual labor, just waiting to be completely disrupted by the next wave of automation?
It forces us to rethink the entire architecture of how care is fundamentally delivered and supported.
It absolutely does. The hospital of future might look the same from the outside, but the walls will be running on robotics. Thank you for joining us on this Talk Tickers edition of our Deep Dive. Keep your portfolio healthy and keep your insights sharp.